here. In fact, it's the first time that I've been in China for well over 3 years. So it's great to be back. And to be honest, I can't even remember the last time I was in Shanghai. I feel like I always go to Beijing, but Shanghai somehow gets missed out. So it's really nice to be here. I'd like to thank the World Gold Council as well as their partners for the opportunity to speak here today. Now, as mentioned, my focus here is going to be on the macro outlook, what we think is going to happen. It's like looking into a crystal ball these days. It's not very easy. There's a lot of moving pieces. So that's really the title of our year ahead, is moving around the pieces, because there's a lot of pieces to be moving around. Now, I think from a growth standpoint, we came into this year feeling cautiously optimistic about growth globally. The caution being that, we were expecting growth to slow. We had anticipated inflation coming down, which we've been seeing. But I think what really surprised us was just how resilient the US and as well the European economy has been surprisingly resilient this year. I think probably the markets underestimated the amount of, kind of still fiscal impulse that was kind of pushing things along. I think the other thing is that meant that inflation didn't come down quite as quickly as we'd anticipated, but we have started to see that disinflation, playing out, and we're now starting to see growth slowing. So you can see on the left-hand side chart, this is our expectations for growth this year and next year. You can see that they're well below trend. On the right-hand side chart, you can see that really we've got production is kind of neutral. It's not really moved around, and global trade is actually in contraction. So we're starting to see that global growth slowing down. The consumer has been super resilient, but we're also starting to see that there's bits and pieces of the consumer, that we think is starting to slow as well. So what are we looking at in terms of global growth? Well, next year we're anticipating global growth to slow to 2.5%. The US, we're looking at growth of about 1.1%. That's pretty slow. It's not recession, but it's pretty close. And I think that's really where we see the risks. And if I say that this year we were cautiously optimistic, I think into next year we're cautiously optimistic, but I'd probably put a little bit more emphasis on the caution, because the ability of policymakers to kind of slow growth without crashing growth, I think is becoming a little bit more challenging. So I would say that right now we're anticipating the risk of a recession at about 30 to 35% over the next 18 months. It's not insignificant, so the risks are there. Now, obviously, what's really driving this is higher rates. We came into this year with rates having risen by over 400 basis points, and just for good measure, they added another 100 basis points. So we're looking at 5.25% to be precise in the amount of rate hikes in the US, and you can see on the right-hand side that's pretty unprecedented. I hate to use that word, but it is. It's been very sharp, it's been very fast, and it's been very strong. Now, what that's led to is really a tightening in the cost of capital and a tightening liquidity, which I think does create risks for risky assets in general. You can see on the left-hand side chart that real inflation is higher than what we are seeing for the US. The average growth for the Fed is 1.8%, but you can see that real yields are much higher than that, which means that financial conditions are very tight. On the right-hand side chart, well, I think that says it all. That's really where we're seeing growth, M2 growth, and it's really, really slowing down. We've really never seen this kind of fall in liquidity. So I think all of that does create challenges going into the market. And I think, one of the big risks here is that there might be some overconfidence that we're getting into a soft landing scenario. The markets are pricing in soft landing. We're feeling pretty good about soft landing. We spent a lot of this year, the markets were worried about recession. Now everybody's in the soft landing camp. And I think that the longer that the markets feel like we're in soft landing, the risk is that, we don't cut rates enough in order to get out of that soft landing, and you fall into more of a hard landing. Our expectation for rate cuts going into next year is we're anticipating the Fed to cut between 100 and 150 basis points. It's pretty significant. Now, we think that with growth slowing and inflation coming off, they should be doing it probably sometime around March. The reality is they probably won't. They'll probably wait. We're kind of, our base case is that they actually start to cut rates in May, probably the latest sometime mid next year, sometime around the summer. But we do anticipate that they're going to have to cut rates a reasonable amount. And why is that? Well, CPI, oops, I guess different slide. So we are seeing CPI coming off quite significantly, and I think that gives them cover to be able to cut rates. You can see that in terms of headline CPI, it's come off quite nicely, although we have different levels that they're coming off. You can see that the U.S. is coming off more quickly. It faced inflation more earlier, and we're starting to see that inflation working through the system, so it's coming off a little bit earlier than what we're seeing in some of the other markets. But we're also seeing CPI specifically coming down on the core. It still has more room to run, but we do anticipate we'll see further disinflation throughout the course of the year. There's still some room for that to run. One of the big risks, though, of course, on inflation is what happens with oil prices. We've seen a lot of geopolitical uncertainty that's pushed up oil prices, what with the war between Israel and Hamas. And of course, we saw a real shock last year with the Russia-Ukraine war. And so we do think that this does create some risks for inflation. But in our view, we think that oil would have to be at high prices for an extended period of time for it to really push past kind of those disinflationary forces that we're anticipating. So I guess the question is, why we haven't really felt the pain? I mean, it's quite surprising. We've raised rates by 500 basis points. We've never really seen that, certainly in, I would say, most of our lifetimes. Why are we not seeing the growth slow as much? Well, yeah, some of it was, the consumer had a lot of cash in their pocket. We saw that fiscal stimulus. But, I mean, the truth is that we haven't really seen it affect in other ways. Like normally you would expect to see it in terms of your funding costs. And I think what's really interesting is that we had this period where, everybody was able to refinance their mortgages. And the nice thing, I guess, about being in the US is that you can refinance it for a very long period of time. They've got 30-year mortgages. Well, if you're not moving, your rate's not going up. Certainly they're feeling it more in other markets like Europe, Canada, Australia, where rates have gone up, and you've got less cushion. You don't have those 30-year mortgages. You might have a 2 to 3 year fixed rate, and then your rates start going up. But you can see that the difference here between what we've got in terms of the actual rates that people are paying is below 4%, but the headline mortgage rates are something like 8%. So as people start moving or having to move, that's going to really bite. The right-hand side chart, again, shows refinancing for corporates. Well, again, corporates took the opportunity when rates were low to lock in some long-term funding at those low rates. And so we haven't really seen a big refinancing wave, but that wave is actually going to start in 2025 and beyond, and you're going to start to see that repricing. So if we don't see the Fed cutting rates by a reasonable amount, you're still talking about a pretty big hit to earnings. It's also impacting governments. I mean, we saw, of course, a lot of fiscal spending that took place over the COVID period in the US. That pushed up debt. You can see the deficits, that went really negative. We've really not seen those kinds of deficits really outside of real significant recessionary periods. But, those higher rates are going to be weighing on governments as well. Now, we talked a lot about the US, but what about Europe? You can see it's a little bit harder a problem to solve in Europe. You've got some countries that have been growing at very slow rates, some countries that have been growing at very fast rates, you can see on the left-hand side chart. But unfortunately, I think what we've been seeing is that inflation still remains a real issue for Europe for the time being. And on the right-hand side, what you've seen, for example, is places like Germany, where inflation is quite high, and it's actually starting to match up with Italy in terms of the GDP deflator. So you really have, I think, from the ECB standpoint, it's going to be a real challenge for them going into next year. We're expecting the ECB to perhaps cut rates, but very modestly. Obviously, they haven't increased the rates to the same degree that the US does, so they don't have as much cushion. But we think what they're going to do is let this play through the economy a little bit more. Maybe we'll see 50 basis points, but more likely to be back-ended. I think for the majority of this year, we're not anticipating them to do anything. They're just going to kind of wait and see how it plays out. Now, in Japan, things are quite different. We haven't really seen them doing much in terms of policy, but we are anticipating that they will exit the negative interest rate environment sometime in the first quarter, possibly. It could happen earlier than this year, earlier than that, sort of later this year, depending on where the BOJ sees the opportunities. You can see here that inflation has really picked up, and we think that inflation looks like it's a little bit more entrenched. And I think, while you hate to say that in most economies, actually, I think Japan's looking forward to that a little bit. That's going to be great for corporates as well, for them to be able to raise prices and things like that. But I think, overall, we're seeing growth growing quite well in Japan. Everything looks to be pretty good there. I think the one economy that we haven't really seen inflation is China. China has been, I guess, flirting with deflation. I wouldn't say that they're in a deflationary environment by any means, but certainly, we've seen kind of on a year-over-year basis that we've really got kind of flattish inflation. But the one great thing, I guess, if you're not living in China, is that what that's led to is their exporting deflation. If you look at, the implications for exports and what that means for other countries, that's been quite positive, I think. So as China exports that deflation from goods that they're selling, that helps from an inflationary standpoint in some of the other markets. Now, I would say that over the last number of years, we've been pretty positive on growth in China, but we're coming a little bit more cautious on that growth. I think China's at a little bit of a crossroads here where, you're moving up the value chain. You've done basically what a lot of the major economies across Asia have done, exports, growth, But we're now in a situation where you've got an aging population, which is going to weigh on growth, and you've got a situation where, you're big. You can't really export a lot more to the rest of the world. That's going to create some trade tensions, which we've seen, globally. And so really what that means is that China needs to shift from that model of pushing investment towards consumption. Really what you see in the US, where you've got consumption as a high proportion of growth in the economy. And I think that's going to be a real challenge. I mean, Chinese policymakers are great, but this is a really hard thing to do. And I think that's going to be a little bit of a challenge going over the next couple of years. You can see on the right-hand side chart that consumption has been quite weak. A lot of that we would, place on the property market. The property market has been quite weak as well. Certainly defaults in some of the private companies, we've seen that. That's been weighing on really selling properties. I think you've seen consumers, they're worried about getting that property. Now, the government, of course, has done a great job of trying to make sure and ensure that these properties get made, that consumers have actually paid for. But the challenge is that you're in that period where property prices are starting to come off. You've seen, that urbanization, and we're getting close to a point where urbanization is going to start tapering off. There's a little bit more room to go, but what that means is that in terms of a thrust for the economy, property investment and all of the ancillary businesses that go on with that is going to slow. So that means that you really do want to shift towards that consumption. But the challenge at this point in time is, if most of my money is tied up in property, I'm not feeling very wealthy. Wealth products, a lot of those wealth management products were also tied up in property. So I think we'll have to wait and see how we go with the property market. We do anticipate that it will bottom and you'll start to see an improvement as the policymakers have put in place a way to kind of stabilize and push property up a little bit more. But I think overall the growth is we're unlikely to see the growth that we've seen in the past, just because we're at that point of development where it's just not needed. Now, I guess the last thing I wanted to say from a macro standpoint before I move on to markets is that one of the key risks that we're seeing this year is just geopolitical uncertainty. And I'm not talking just about the US and China. I'm talking about there's a lot of geopolitical uncertainty out there. You can see on the left-hand side chart, the number of wars have picked up. They're getting, unfortunately, worse in some respects. You're starting to see an increase in the number of internationalized, intra-regional wars. That, for example, that's like proxy wars where you've got more people involved in places like Yemen and places like Syria. And of course, this year, coming up, we've got a lot of elections. And elections can be pretty destabilizing. Certainly the one that a lot of people are focusing on is the US election. We'll have to see who the final Republican nominee is going to be. If it is Trump, he's always a wild card. You never know what's going to come out of his mouth. And so that creates a lot of volatility in markets. So we think that a lot of this uncertainty will drive volatility across markets, which really is the reason that we're feeling relatively cautious on risky assets. Oops. Let's move to fixed income. We like fixed income. We're feeling pretty bullish on fixed income to some degree. I mean, it's been a bad, 3 years? I don't think anybody's seen such a bad 3 years for fixed income markets. But, we've seen yields back up. And I think from a structural standpoint, we're likely to see those yields coming back down again. I mean, they got pushed up because of inflation, but structurally, you've got an aging population in the U.S. and as well as many economies, and so overall, we anticipate that we'll see kind of growth in the U.S. at around 2% as trend. So we should start to see fixed income yields coming down, which is quite bullish. I guess the other thing that's interesting is that if you look at forward inflation prospects, you can see that the markets actually aren't pricing in a higher for longer. The markets are actually pricing in the expectation for rate cuts. Now, of course, the markets can be wrong, but I think overall we're anticipating that we will see the disinflation continuing. Maybe it's not going to come down in a straight line. That could create some volatility. It could push yields back up. But overall, we're anticipating that this should be pretty positive. Now, what about the dollar? The dollar really is complicated for a lot of investors that we speak to across the region. We're anticipating that the US dollar is moving from what's been a 10-year bull cycle to more of a bear cycle, but calling it's hard. I think the market's been expecting the US dollar to soften for, the last couple of years. So it will be a process. Certainly, we've been seeing the US dollar weakening lately as anticipation of rates coming down. That rate differential is going to close. That will be, negative for the dollar. But remember, the dollar is also still the safe haven. And I think that if we're seeing periods of volatility, if we're seeing recession, that's going to be positive for the dollar. So you're going to have that shift towards the dollar. So it may be a little bit of a choppy ride, but I think at this point, just given that it's very difficult to kind of call the bottom or call the top of the market, now is not a bad time to start thinking about doing some hedging. Now, fixed income versus equities. You can see here that given where yields have moved up relative to equities, fixed income is actually looking pretty good. In fact, we've not really seen this fixed income being this competitive to equities in the last 20 years. So what's been happening in asset allocations as bond yields have been coming down, investors have been looking for returns, so they've been going more and more into equities. Now I think we'll start to see that reversing a little bit. And US dollar bonds are back. The yields are actually quite attractive. While, of course, this is a little bit old. We've seen such a rally in yields in the last little while. But, if you look at the type of the returns that you can get, the returns were looking good, positive for next year, even if we continue to see rate hikes. We don't think that we're going to see more rate hikes. We think we're done. But, should we be surprised and there be another hike there? We do think that fixed income will still do reasonably well given where yields are. They can still have some positive returns. And in terms of where we like, I would say that we particularly like the US because we do anticipate rates to come down. We're a little bit more cautious on Europe, and I'll show you the slide on Europe. But the short end of the rates markets look very attractive from a yield versus duration standpoint. So we do think that in the U.S. maybe a little bit of barbell because there's still a lot of uncertainty. So cash still looks pretty good. The short end of the curve looks pretty good. But in the U.S. we still do like duration. Maybe a little bit more cautious in Europe. So maybe sticking to the short end until we feel like okay, there might be some opportunity for rates to come down. We're a little bit more cautious on credit. You can see here that where spreads aren't particularly cheap relative to the long-run average, and the quality of the market has deteriorated. There used to be a lot of AAAs. Where's a AAA these days? And a lot of AAs, but we've seen that shift more towards BBBs. So we're seeing the quality of both the markets in the U.S. and Europe deteriorating. So we do think that they're not pricing in a lot of the uncertainty, so we're going to be a little bit more cautious there. At the same time, while financial positions in some of the investment-grade companies are still pretty good, we are starting to see some weakening in some of the earnings, and so overall that's going to lead to some weakening in credit quality. Similarly, in high yield, we've seen yields shoot up quite significantly. But we do, unless we start to see a very significant reduction in rates, in particular, Europe is going to be more vulnerable for those high yield space. They've got earlier refinancing than what we have in the US. And we do expect that we'll see defaults starting to rise. So not a lot's priced in. I think they're pricing in like a perfect soft landing. And so it doesn't look for us particularly cheap at this juncture. Local currency debt. I think in the local currency side, the real challenge, I think, is the fact that you've still got what we think is going to be, periods of strong dollar, and that's going to weigh on a lot of the local currency markets. I think the other thing is that, the great thing about emerging markets is they hiked rates sooner, so the inflation started coming off sooner. We've already seen some of them cutting rates, which is great, but that differential between the US and local currency isn't super compelling, and just with the hangover potential for US dollar makes us a little bit cautious. But I would say that, oops, I don't know where that page went. Hard currency. Let me talk about hard currency debt. I don't know where that slide went to. Was it here? No, missing. Hard currency debt in the emerging market, though, we do think is compelling. A lot of the defaults in some of those high-yield sovereigns have actually come through. Spreads have widened. So you're getting paid quite a bit for being in some of the hard currency. And of course, when you're in hard currency, you have less risks of dollar strength. But obviously, from your perspective, maybe on a hedged basis. OK, let's move on to equities. We're a little more cautious, as I said, on equities. Sorry, just keep on the time. A little bit more cautious on equities. What we've seen this year, a lot of the increase or improvement in equities and the returns have really come from widening in PEs. It's not really come from earnings. And so, I think we're going to start to face some more challenges this year, going into next year, as we start to see growth coming off. That's going to create earnings challenges for companies. Again, the cost of capital is high, and that's certainly going to be weighing on EPS. Now, valuations. It's hard to get super excited by valuations. They're not particularly cheap anywhere. In the US, 2 standard deviations above the average, driven predominantly by those, what they call them the Magnificent Seven, those very big, large caps. Exit that, they're slightly below long-run average in the US. Europe is 1 standard deviation below the average. Emerging markets is kind of bang on. So valuations not super compelling, but I would say that, even so, we're a little bit more positive on the US than some of the other regions. Why is that? Well, I think just because we want to focus on quality. If you're going into a year where growth is really slowing, you want to be in quality companies that have very strong and stable earnings potential, that they're lowly levered. All of those things we tend to see in, with the US large caps. Obviously, valuations are a little bit of a challenge, but generally speaking, more stability in earnings, I think. If you look at some of the other markets, we've been seeing very significant EPS revisions coming down. You've seen that stability that's been playing out in the US on that right-hand side chart. A lot of the other markets have been coming down. So I think the challenge here for some of the other regions is just how resilient those earnings are going to be. I think in Europe in particular, we're a bit worried about the margins. I think as inflation starts coming off, margins tend to come off as well. Not going to be very positive for the earnings there. And of course, you've got in Europe a lot more, cyclical style companies which are going to be weighed on by the slowing growth. Japan is one market that we do like. We've started to see the inflation rising, which is actually good for companies. That gives them the ability to increase prices. The stock market is also, we're seeing structural changes that they're needing to increase their price to book up beyond 1. A lot of these Japanese companies have a lot of cash on balance sheets, so we're starting to see more buybacks. We're starting to see more dividends. So I think all of this is going to be pretty positive for Japan, as well as the fact that growth is still holding up quite well in Japan. So I think overall, we're quite positive on Japan going into next year. Emerging markets, again, we're a little bit more cautious. Number one, a strong US dollar, is going to weigh on emerging markets. I think in terms of our views on China, we think that the market has bottomed. But, given our uncertainty about growth, it feels like it's going to be a little bit of a range-bound year. Certainly a better year. We've had a number of rough years in the Chinese stock market, but it's likely to be, we think, range-bound for Chinese stocks. And I think in emerging markets in general, again, a lot of cyclical names. If growth is slowing, if we're seeing less options to export to the U.S. as growth is slowing, that's going to be a bit of a challenge. I talked about quality. I think I'm going to skip through in the interest of time here and go end on gold. Got to end on gold. I'm not going to talk about what the outlook is for gold because I think you're going to hear a lot about that this morning. But what I would say is that we do like gold. In our tactical portfolios, in fact, we've had gold pretty much for the better part of the last 2 years. We see it as a great diversifier. But also, you can see on the right-hand side chart, when you're seeing increasing volatility in both bonds and equities, we see gold doing well in those environments. So with the geopolitical uncertainty, with the potential for a higher market volatility, gold acts as a really nice hedge.